Alright, this is going to be a special video for the advanced certification. If you're pursuing the basic, you don't really have a need to watch this one. If you're pursuing the advanced, you should watch this one. It is a covered topic for the advanced exam. It's really focused on in the third scenario. Those three questions are kind of focused on this. So the topic is health savings accounts, also known as HSAs. HSAs work by contributing money into a account which is there for you to pull at anytime you need it. Okay, and it has a lot of special properties with it because it's just given such status by the IRS and the lawmakers. Okay, the concept here is that you put money in, it sits there, and when you need it for medical expenses, you take it out and you can use that money for medical expenses. But it's got such great benefits. It's become very popular in the last decade or two. Okay, and let me explain to you some of these benefits. Okay, when you put money into the account, you get a deduction. Just like when you put money into a traditional retirement account, you get a deduction, you reduce the amount of taxable income you have, and therefore the amount of tax you will pay. Okay, so putting money in gives you a tax deduction, which in other words, it's tax-free going in. Okay, while it's in, during its time inside, you can have it sit there and not do anything. It can just sit as cash in account, but you can also invest it into certain mutual funds and stocks and so on. And so you can actually invest your health savings account and make earnings off the stock market, okay, while it's in there, just like a retirement account does. And just like a retirement account, while it's in there earning that, it's also tax free here. All the earnings on this account while it's in there is tax free. Here's where it deviates from traditional retirement accounts. When you pull that money out and you have to use it for medical expenses, and if you use it for medical expenses, once again, it's tax free. This makes it the only triple tax free thing. Okay? It is tax free going in while it's there and when it comes out. Okay? Which makes it very, very powerful as a investing tool because everyone's going to have medical expenses. Pretty much everyone's going to have a large amount of medical expenses in their life, especially once they hit retirement age. And so this gets used as a way to retire in a different form, or save for retirement in a different form other than traditional retirement methods. Okay, so I want to talk about a little bit about the rules for it now. Now that we understand how good it really is, we're going to talk about the rules. Okay, when you put the money in, if you are single, you can put up to 38.50. Yeah, that's right. 38.50. And if you're a family, which means you're not single, if you're married filing jointly or you're head of household or whatever, and then you get into married, it's a little bit more than double, not my bunch, but it's a little bit more. Okay, you can put up to that much in as a contribution. So these are contributions. That's how much you can put in per year. If you are over the age of 55, yeah, then you can put over, you can put an extra 1,000 in. So if you're over 55 and you're single, you can put 48.50 on in. If you're over 55 and are a family plan, you can do 87.50. Okay, so it's called catch up, is what that is. It lets you catch up just in case you're a little bit behind. All right. Now, there are special rules about who can contribute to this, and the rule is you have to have a high deductible health plan. Okay. I'm not going to go too much into insurance stuff right now, but the main gist is it has to be a high deductible plan, and there's specifications for that on the IRS website if you're unsure about it. But most plans will just tell you if they qualified as HDHP, and therefore qualify for HSA. Okay. But the gist is, if you have a high deductible, which is the amount you have to pay before insurance really kicks in, then HSAs you can contribute. But this leads it to exploitation because currently, let's say year one, I have high deductible health plan while I'm young and healthy. Year two, I still have that high deductible health plan and I'm contributing HSAs these years. And then I get married and we don't plan to have kids yet or whatever, and we contribute to the high deductible health plan another year, and then we start to go, okay, now we're going to get everything medical taken care of. My leg's been a little bit, weird lately, or, you know, you've got a funny thing on your ear, whatever it is. You're going to go and spend that year. You're going to get a insurance plan with a very low deductible, and you're going to use all the HS money you saved up from all these years, you're going to spend it here. Because you can't contribute that year, but you can take your money out. The HDHP rule only applies when you're putting money in. It's not about when you're taking it out. So when you're in those years where you can kind of, afford the cost of not going to the doctor that year or whatever, you can put that money in with a high deductible. And when you kind of build up all your medical expenses and you go to the doctor, get everything taken care of in that year, and you set up yourself up. So for me, for instance, when I was single and working, and I mean, I'm generally a healthy person, so I was contributing to HSAs every year as a single person with high deductible, never going to the doctor, never really having medical expenses. So I didn't care about needing to use my HSA money. And then I got married, and and at this point now with a wife, and that type of thing, I'm set up for having now we have a low deductible, and I've got money in my HSA to cover if anything happens, and my money in the HSA not only covers what would be a high deductible, but because of now we're using a low deductible, it covers my low deductible many times over. So I have several years of HSA money ready for any potential expenses. So if you use it correctly, it becomes a very, very powerful tool. Okay, but you got to make sure you invest in the years that you have the high deductible plan. That's the key phrase there. That's the current ruling on it. Contribute in a high deductible health plan. It doesn't matter when you take it out. What matters only when you take it out is that from qualified medical expenses. Okay, we'll talk more about qualified medical expenses in the um, standard deduction and itemized deduction video. Uh, but for now, just know, as long as you're using it for medical expenses, you're good. It's tax-free coming out. Okay. When you take the money out, there's going to be a form called 1099 SA. Anytime you have 1099, 99 refers to money that the person is receiving. So we're getting money from our health savings account. That's the form that they're going to have showing how much money they took out. So you'll just, ask them about how much medical expenses they had. Is that all for medical? Was any of that money not for medical? That type of stuff. Okay. And as far as contributions go, most of that is going to be recorded on Form 8889. So I'm going to go ahead and open that up for you. Here is that Form 8889. It's a one-page form that kind of goes over your contributions, and then here it kind of talks about your distributions, um, as far as how much qualified medical expenses you have and how many deductions or distributions you had from the plan, and therefore how much is not tax-free, and whatever's left over would be taxable. Okay. It doesn't matter if you make the contribution or someone makes it on your behalf, whether it's your employer or your friend or your spouse or your mother or your aunt or your grandma. It doesn't matter. If it's in your account, it's going to be listed on here on this form somewhere. So up here we have HSA contributions you made or were made on your behalf, but not an employer. But down here we're going to have your employer contributions here. Okay. So all the contributions that get made are going to be reported on this form, and it's going to be attached to your tax return if you are claiming the HSA deduction or you have distributions that year for whichever reason you have it. You might have both in the same year. You'll have either part one or part two or both. Okay. I do want to talk one more thing on E12 adjustments to income. There is a spot for the health savings account. It's got some information here as far as, well, were you eligible or not, and how to understand that. But it also has the information as far as how much they can and cannot take as a deduction. And so family plan, self plan, and the over 55 is all right here for you to look at. Okay. I do want to point out that the HSA has no better way to phrase it than the ugly cousin. Okay, the HSA have a cousin. It's not as good, and it's called the FSA, flexible spending account. I find it funny that they use the term flexible because it's really not. Okay, here's how FSA works. FSA works on the same rules of the triple tax in, during, and out, triple tax free. Okay. But they get a benefit. They do get one slight benefit, which is you do not need to be HDHP. You can have a low deductible plan and have FSA. And obviously you're thinking to yourself, oh, that sounds way better. Here's the catch. With an HSA, any money left over in your account at the end of the year, you keep and you still have. It's still sitting there in the HSA. So the money I put aside 4 years ago into my HSA, it's still sitting there. I can still use it today if I need to. The FSA year end, you lose all of it. Whatever's in there, you lose. Okay? So if you don't use it in the same year you put the money in, it's gone. You don't get, it's gone. They just get to keep it. I don't even know who gets to keep it, but I assume the FSA company gets to keep it. Okay? So you gotta be very careful if you use the FSA. It can be a tool, but you have to be careful with it. Is the thing. So if you're planning with the HSA, like I talked about a little bit earlier, where you're putting HSAs for several years and then spending a year taking care of any medical issues, what you might do is you might put into the FSA that year that you plan to do all your medical expenses, and then use FSA money first, and then if you need anything else, take from the HSA after. So you gotta be careful with FSA. It still can be useful, but it's just nowhere near as good because of that fact you lose at the end of the year. So keep that in mind. I don't think there's really any questions about the FSA on the exam, but it's just going to come up in conversation if you ever talk about HSAs with other people. Okay. So like I was saying, HSAs are a pretty hefty subject in that, and so that's all going to be under the third scenario. But for right now, until you learn more about what is and what isn't a qualified medical expense, which we'll do in a different video, we'll come back to that. So right now, all I want you to answer is 6 and 7. Questions number 6 and 7 from scenario 3. Okay, review that information on what I've gone through on this video. Don't be afraid to also use the 4012. Page E12 has the best information in regards to that. And don't forget, it's also nice to look at Form 88, 89 as far as things that might be on there. Okay? Good luck.